All right, I don't have candy. I know. Well, hey, it's okay. Everybody stand up. I have an idea.
Yes, first one up. I love it.
I have an idea. First idea. So instead of, why don't we do this? Get everybody's blood flowing.
We don't have any music.
Brad put me up to this. I'm getting $50. Just do it. So instead of the YMCA, why don't we do the TCJA? Just kidding. You can sit back down. I couldn't figure out how to do the J in like 5 minutes. The 5 minutes that he gave me. So at least you got up. So we have 50 minutes to talk about, kind of piggyback on what Don and Bob talked about this morning, the impact of the TCJA on the valuation of privately held businesses. So, and we're going to kind of keep it brief when we go through some of the details that Bob and Don went through. But some of the things we want to talk to you today directly impacting what we do are a number of things. As a result of the TCJA, which we know is a huge tax enactment after about 30 years of not so much of a crazy time in the tax environment, but this is a major shakeup. And you know, the question that we got our department right after the TCJA was enacted is, how does that impact the value of our business? And does it impact the value of our business? And we believe yes, the TCJA will have an impact both on an immediate basis and also on a long-term basis. When I say immediate basis, if you're paying less tax, if you're a C Corp, you're paying less tax, of course you're going to have higher cash flow, higher income, so theoretically your value is going to go up. When I talk about long-term effects, we're talking about the reason for one of the reasons for the Tax Act is to stimulate the economy. And so if you think about it, if you have more cash flow, what are you going to do with it? You can do a number of things. If you reinvest in the business, you're going to see maybe some longer-term effects of that cash flow that you're plowing back into the business. So we're going to see both short-term and long-term effects. Impact is going to be a numerator and the denominator of the equation that we always talk about with respect to valuation, because most businesses, if not all businesses, are valued on the income approach, which is cash flow and the risk associated with achieving that cash flow. So we're going to talk about both sides today. The increase in the cash flow, which is the numerator of the calculation, and then the denominator of the calculation being the risk rate. We'll talk about how the TCJA has affected that. The specific provisions that we're going to walk you through today are in front of you. We're going to talk about, obviously, the corporate and individual tax rates and how that affects what we do. Limitations on the deductibility of interest, capital expenditure cost recovery, research and experimental expenditures, net operating losses, as well as we'll speak a little bit about the temporary sunset provisions, which will have an impact on some of the modeling that we do.
All right, so we're going to talk about each of the three different approaches to valuing a business. And the 6 pieces that Melissa talked about, you'll see how they kind of weave through each of the 3 approaches and really impact our opinion of value at the end of the day. So the first being the income approach. Melissa said, the income approach is an approach that we're going to look at in almost every single engagement that comes through our firm. It's basically built upon the premise that the value of a business is built on the future returns that you're going to get from owning that business. Specifically, it is that economic benefit stream, that future economic benefit stream, brought back to present value using a discount rate which is commensurate with the risk of investing in that business. So whenever you look at the income approach, there are 3 different things that we're going to be quantifying under the income approach. Melissa talked about 2 of them, the numerator being what is that future economic benefit stream, the denominator being what is the associated risk with that benefit stream, and the third one being what is the expected growth in that benefit stream. Those 3 pieces are going to drive these 3 different items at the bottom of the screen, being which model are we going to use. There are 2 different ones that we can use. That's going to be driven on what we expect the future growth of the cash flows to be. Are they going to be linear? Or are they going to be nonlinear? What is the cash flow calculation, and how is that impacted by the Tax Cut and Jobs Act? That's the numerator in our equation, and the discount rate being the denominator. So the 3 different pieces that we're going to quantify, we're going to walk through each of them. So the model selection. two different models that we're going to look at. Mechanically, they're actually the same exact formula, but one of the models, being the CCF method, will keep one of those three assumptions, being numerator, denominator growth, will keep one of those constant, so it's more of a shortcut method. The DCF method is a little bit more flexible, but a little bit more complicated in terms of the amount of work that you have to do this, because the discounted cash flow method assumes that that benefit stream is going to grow in a nonlinear fashion. So what we do under the DCF method, you're going to forecast over a period of years. You're going to take that forecast out to a point in which you believe that benefit stream is going to start growing in a linear fashion. It's going to be a constant growth. At that point, there is a terminal value calculation. What that means is it's not the end of the business, it's the end of the forecast period. So that terminal value calculation, the point of stabilized growth, will take us from the end of the forecast period and calculate the value into perpetuity. So we're going to bring all of those cash flows back to present value. Alternatively, the CCF method, again, a shortcut method in which we believe that the growth in the business is going to be constant. Where does this method usually find itself whenever we're looking at a business in practice? You're going to be seeing this in a business that either is a mature business in a mature industry where there's not going to be a lot of growth prospects, but there's also not a lot the business is going to do to see significant decreases. Or a practical example that we've seen recently, we had a client that came in, operated a parking facility. So he's almost at full capacity, and to the extent that he doesn't have the ability to go build another parking garage or acquire more parking spaces, his growth prospects are pretty limited. So you can assume businesses like that will grow in a linear fashion. However, a business that's growing, usually you're going to see that DCF method. You're going to expect varying levels of growth. Now, in terms of how does the Tax Cut and Jobs Act impact the model selection in the income approach, really how it's going to impact it is where do we believe is that point in stabilization, that stabilization in growth in the cash flows going forward. So with the Tax Cut and Jobs Act, Bob and Don mentioned earlier this morning, there are certain provisions of the Act that will lapse over time, specifically being some of the capital expenditure, as it relates to valuation, some of the capital expenditure, cost recovery methods, the depreciation, being able to run that through the P&L, but then also the individual income tax rates for those pass-through entities. To the extent that those will expire in the future, and as of today, it looks like we have to assume that they're going to. Even if a business isn't expected to experience any growth in top-line revenue, the bottom-line cash flow will experience varying levels of growth just by nature of these sunsetting provisions. So in terms of what we believe is going to happen from the Tax Cut and Jobs Act, appraisals of businesses are likely going to be leaning more towards the DCF, because even if the business doesn't expect significant top-line growth, it's likely that that cash flow number, the bottom line number, is going to be variable over the next few years.
So regardless of what method that we're using to calculate the value of the business under the income approach, we're always going to be looking at the free cash flow to invested capital. When we talk about invested capital, it's two types of capital holders. It's the debt capital holders, the bank, the lenders, and then the equity capital holders. Of course, the equity capital holders are subordinate to the debt holders of the business. So when we look at free cash flow, it's that equation that you see in front of you. It's going to be the net income of the business, and regardless of whether we're valuing a C Corp or a flow-through entity, S Corp, LLC, we're going to tax affect the business because there's going to be tax taken out regardless of if it's at the corporate level or at the individual level. And I'll talk a little bit about the difference now between the value of S Corps or flow-through entities and C Corps post TCJA, because it gets a little bit wonky after some of the tax rates that have been enacted. So we're going to start with net income after tax. We're going to add back depreciation, any other non-cash items, amortization. We're going to add back interest expense, and we know that maybe not all of the interest is going to be deductible, but we're going to add back interest expense net of the tax benefit. And then at the end, we're going to subtract off a couple things. Investment in capital equipment, anything like that the business is going to invest in that is considered a capital investment. We're going to take off the cash flow associated with that. And then also, we're going to look at what are the incremental cash flow needs of the business with respect to working capital in order to fund the ongoing growth of the business outside of those large capital investments. So that's, at the end of the day, that cash flow is going to represent the cash flow that's available for what? One, to pay any debt that we have, and then two, the residual would therefore be available to equity holders, because we've already accounted for all of the cash flow that's due to all of our stakeholders and the cash flow that we are considering in terms of growth and funding the business. So some key considerations with respect to these cash flow calculations that we have right now, a couple things, or a few things. The federal income tax rates are going to certainly have an impact on that cash flow number. Of course, net income, the top line. Deductions. Brad and I will go a little bit deeper into these deductions and see how that's going to impact value or cash flow and ultimately value. And then we'll also talk a little bit about net operating losses. So let's start with federal income tax rates. C Corps, as Bob and Donna talked about, were previously taxed under a graduated system, with the highest rate being 35% for federal tax purposes. Now we're at this flat 21%. So obviously the magnitude of that reduction is going to vary depending on a number of things. The benefit will not simply be the difference in the cash flow associated with the tax rate reduction, but rather the difference in the effective tax rates paid by the companies after taking advantage of all the tax positions of the new law compared to the old law. So let's just go through a quick numerical example that is in your materials. But if you look at prior and post TCJA of a company that has $20 million of pre-tax income, they're operating in the state of Pennsylvania. They're around a 10% corporate tax rate. So we take 10% off. We have our federal taxable income, as we're able to deduct the state at getting at the federal income tax, or the federal taxable income. After that, prior to TCJA, we see 35% being lobbed off of that 18 million. After, you see 21%. So after tax income prior to the TCJA, slightly under $12 million. Post TCJA, $14.2 million. So as you can see, the effective tax rate, if you're in the state of Pennsylvania exclusively, we have an effective tax rate of 41.5 prior to the TCJA. Post TCJA, we're at 28.9%. So right off the bat, when you talk about that top number in the cash flow calculation, what do you think? We see a pretty sizable bump up because companies are going to be paying less tax.
So that slide with the rates on the tax rates, we're going to use those tax rates in a couple different slides, so just know that that's how we calculated them when we pull those up going forward. Now, in talking about deductions, so again, we're quantifying the numerator in the income approach. We're quantifying what is the expected future cash flow. So some key considerations in terms of deductions. This is getting us back to what is our income tax liability. We're going to look at interest expense, the ability to deduct capital expenditures through depreciation, and research and experimental expenditures. Now, interest expense, Bob and Don talked this morning about how there are now limitations to interest expense. From the valuation perspective, whenever Melissa put that formula up earlier, that debt or cash flow available to invested capital, that is a pre-debt service number. So it's a pre-tax or is a pre-debt service number, pre-interest expense, pre-servicing any debt. So in terms of how the deductibility of interest expense is going to impact the free cash flow calculation, it shouldn't impact the numerator itself. We'll see how that's going to impact the denominator, that portion of our weighted average cost of capital that's attributable to debt. However, whenever we pull up this same calculation, there's an adjustment to the calculation, but at the end of the day, that free cash flow to invested capital should be the same whether we're calculating it prior to or after the enactment of the Tax Cut and Jobs Act. The only difference in this calculation being we need to make sure that we properly account for that 5th line down, non-deductible interest expense portion of this. Again, that free cash flow to invested capital should be the same number no matter what. Now, the implication of limiting the deduction for interest expense, again, not a huge difference in the numerator. Where we're really going to see it is in the impact of the denominator is going to make debt less attractive for businesses. Now, there could be certain circumstances where this becomes an issue because companies will both be paying taxes in a year where they experience a loss. So let's take into consideration you have a business, $30 million in revenue. So I mentioned this morning, if you're under $25 million in revenue, you can opt out of this interest expense issue. However, we're going to be $30 million, we can't opt out of it. They're a highly levered company, so they paid $2 million in interest expense that year. The adjusted taxable income, that income prior to considering the interest expense, $1 million. So the business experienced a cash flow loss that year of a $1 million loss, the $1 million income less the $2 million of interest expense, but they're still going to be liable to pay some money to Uncle Sam because he looks at it prior to the interest expense, taking into consideration the interest expense from that adjusted taxable income. So at the end of the day, how it's going to impact the valuation assignment is it's going to create some modeling issues, but not necessarily going to have a huge impact on the outcome itself. Capital expenditures, on the other hand, we know under the Tax Cut and Jobs Act, we now have accelerated almost all of our capital expenditures. We're able to take a depreciation expense for 100% of the expenditures in the year of purchase. What that's going to do is it's going to, accelerating that expense is going to increase the present value of that tax shield. So while depreciation in and of itself is a non-cash expense, there's a cash flow impact in that ability to shield taxable, otherwise taxable income. However, you have to take into consideration the other piece of this. So accelerating any expense is obviously going to increase the present value of the tax shield associated with that expense. However, now with the new lower tax rates, we're actually saving less money on the dollar after the Tax Cuts and Jobs Act than we were before. So we're going to walk through a numerical example to make this a little bit easier to understand. So we have a company, they're investing $2 million in a piece of equipment. Prior to the Tax Cut and Jobs Act, here's those rates, 41.5% tax rate. They're allowed to accelerate that expense, but it's still taken over the 5-year life of the asset. Under the Tax Cut and Jobs Act, we're going to be able to take the full expense in the year of purchase. However, we're only shielding ourselves at a tax rate a little bit under 30%. So how does this look numerically? This is on page 14 of your materials, or of our chapter in your materials if you want to look at it there. But the top piece being prior to the Tax Cut and Jobs Act, we're going to be able to take that depreciation expense over the life of the asset, present value of the tax savings at a 41.5% blended tax rate, just under $700,000. Under the Tax Cut and Jobs Act, however, we're able to take that full $2 million expense this year, but we're only shielding ourselves from taxes at a rate of 28.9%. Gives us a present value of that tax savings a little over $500,000. So really what it means is the difference is the present value of the tax savings was actually higher prior to the enactment of the Tax Cut and Jobs Act than it is afterwards because we're paying less taxes. So again, counteracting forces here. Now, one thing that we want to make sure that you take away is although the present value of this benefit is going to be lower under the new Tax Cut and Jobs Act, it is really going to be dwarfed by the fact that businesses in total will be paying less taxes. So while this specific piece of it would negatively impact value, you're still going to see an increase in value for a profitable company based on the decrease in income taxes paid. And finally, research and experimentation expenditures actually works in the opposite direction under the Tax Cut and Jobs Act. They talked about we are now not allowed to accelerate these types of expenses. So we're delaying our ability to deduct these expenses for tax purposes. Anytime you delay an expense, it's obviously going to decrease the present value of that tax shield.
So with respect to net operating losses, as Bob and Donna discussed, we're no longer, with certain exemptions, but we're no longer going to be carrying those losses back. We're going to be carrying them forward indefinitely, but they can only reduce up to 80% of taxable income when they're carried forward. So what we see here is much like depreciation, the TCJA provisions will negatively impact the present value of those NOLs going forward as they work to defer their use into the future. So very much like the depreciation, and any calculation that we do when we assign present values to them, because as you defer them and put them more out into the future, it's going to have a lesser impact as you present value them back to present value. And also like the depreciation, as Brad had discussed, the dollar amount associated with an NOL will also be lower going forward due to the lower tax rates. So something else to keep in mind. Another thing that we've observed when we're working on our valuation clients is companies with existing deferred tax assets reflective of the future use of those NOL carry forwards, we may see a significant decrease in their total assets on their balance sheets as the value of these benefits is going to be adjusted downward, basically after those two items are taken care of. So as you can see, some of the provisions of when it speaks to deductions are going to have an impact on valuation. And they're going to be looked at differently because they're going to be tax shields that we use and we look at for free cash flow in different ways. So you can see that in the past, where we would defer to using what Brad called a CCF, which is that single period of cash flow which we're going to blow out into perpetuity, it might serve us better to work with our clients to do a discounted cash flow model and look at how the cash flow plays out over a discrete period before we decide to take that single period and grow that out into perpetuity. So that's really, with respect to the numerator, how we see things changing as a result of the TCJA. But as you can see, a lot of moving parts, and a lot of them obviously are going to have to do with the tax shields. Because even if you have a company that hasn't changed even materially from 17 to 18, their value is going to change based on some of these provisions that we need to look at going out into the future. So that's the numerator. If anyone has any questions, we can address them or talk about them afterwards. But moving on to the denominator of the calculation, and that's the discount rates or the risk rates that we assign that are associated with achieving those cash flows. And when you talk about a discounted cash flow model where we're projecting out 3, 5, 7 years, we're actually looking at the risk associated with recognizing those cash flows not only at the times, but at the amounts that we and our clients are projecting that they will achieve them out into the future. So the development of the discount rate, we do think that there's going to be some play there, but let's give you a little bit of a primer before we move into seeing how that's going to be impacted. So numerator, the cash flow is going to be that cash flow available to all the capital holders of the business. The denominator must match that. So the denominator that we use is going to be called a weighted average cost of capital, because we're going to look at the cost components of both aspects of your capital, your equity capital and your debt capital. Debt capital, as you'll see in a couple slides from now, significantly cheaper than equity capital. Many reasons for that, but we'll get into that in a second. So when you look at your weighted average cost of capital, it's going to be two things added together. It's going to be the overall weighting of the equity times the cost of that equity, plus the overall weighting of the debt, and we're talking about senior debt, times the weighting of that debt in the capital structure. And then we're also going to look at the tax savings because you get to reduce it by the interest expense. So that's basically those two items, those two weighted costs added up. It's going to be the overall weighted average cost of capital of a business, of the enterprise. So some considerations that we're going to walk you through: capital structure. What does that look like for the business? And we get that question all the time when we're valuing business. Well, how do you look at our capital structure? What's the cost of debt? Cost of debt's going to change post TCJA. And what's the cost of equity? What would it cost Brad? What would it cost to induce Brad to invest in my small privately held business? When you talk about capital structure, typically when we're going to value an entire business or a controlling interest in a business, we look at what's that optimal capital structure, or what are your competitors using out in the marketplace as their average or median capital structure. Just because we have a business that has decided to pay everything down in cash and not incur any debt, that doesn't mean that that's an optimal capital structure. It's very conservative to do that. In some places, it might be the right thing to do, but you can lower your cost of capital by virtue of infusing or introducing some debt into the business. So valuing a controlling interest or entire entity, what we're going to be looking at is that optimal capital structure. And it will depend, from company to company, it can depend on the stage of the life cycle of the business, what are the industry risks that are out there, competitive pressures, and other specific company risks that are attendant to the subject company. We do know that, obviously we do have clients that are very reluctant to incurring debt because they feel that that creates a strain on the company's financial position. They have to adhere to contractual repayments of the debt, loan covenants, and there's also that default risk that clients are considering. So when you talk about debt financing, as I said, you can go out to the bank and get a cash flow based or an asset based loan for substantially less than it would cost for Brad or myself to invest in a small privately held business. And why? And at the end of the day, as equity investors, Brad and I are taking on the most risk. So we want to be compensated for that risk. And I'm going to show you how we assess that risk a few slides from now. But all else being equal, when you limit that deduction, as Bob and Dawn talked about this morning, for interest expense, it makes debt financing a little bit less attractive. But at the end of the day, it's substantially cheaper than, it'll be substantially cheaper than equity. But it remains, I think, in talking to my friends and contacts out in the banking community, it really remains to be seen what the impact of the expense deduction and TCJA ultimately has on the way companies are perceiving debt. So pre-tax cost of debt, basically it's just the interest rate that the company is going to incur for their next dollar of financing. We have companies that say, well, I have debt on my books at a 4% interest rate, and then we say, well, we want to know what, if you had to go borrow money tomorrow for a capital investment, what is that rate? So we're going to look at the market rate that exists at the date of valuation based on the next dollar of financing. So due to the deductibility of interest expense, the true cost of debt is lower by a factor of 1 minus the tax rate. So lower corporate taxes under the TCJA will increase that after-tax cost of debt. And then higher discount rates obviously will decrease the present value of the business, and I'll show you how that works. But taking a look at the cost of debt, if you have a 6% interest rate prior to the TCJA with a 41.5% combined federal and state tax rate, Pennsylvania tax rate, the after-tax cost of debt is 3.5%. It's lower because that you get more of a tax benefit. Under the TCJA, with that combined rate of slightly under 29%, your after-tax cost of debt is 4.3%. It's higher, yes. Is it materially higher? No. But it will have, certainly it will have an impact on that side of the weighted average cost of capital. So after we solve for the debt piece, we want to take a look at, okay, what is the cost of equity? Cost of equities we talked about in the past. For those of you that have been in at CPA day or CPE day in the past, we've talked about the income approach and building up that cost of equity. And it's basically layering on premiums as we go down the line here. So we're going to start out with a risk-free rate. The risk-free rate is associated with a risk in treasury bills. Added to that is an equity risk premium, the premium that you would expect to receive in return for broadly investing in the S&P 500. On to that, for the companies that we're valuing, the small privately held companies, comes a premium for size. Those companies are vastly smaller, even the smallest companies that are traded on the S&P 500, those companies that we're valuing are significantly smaller, so we're going to add a premium for that. Why? You're smaller, more risk, less access to capital, probably thin management, all these issues associated with being a smaller company. To that, we're going to add the specific company risk premium, and that can be anything that's specific to the company that is a risk associated with achieving those cash flows into the future. So as your example shows you on page 20 in your book, pre and post TCJA, we don't really see anything happening to the business. Unless the business dynamics have changed, which result in more risk associated with that business, that happens outside of the TCJA. So what we see is really no change as a result of the Tax Act with respect to the cost of equity. But when you plug these numbers on page 21 of your materials, when you plug these numbers into a weighted average cost of capital, I'm going to show you how at the end of the day how that impacts the calculation of the denominator that we look at. So prior to the TCJA, and we have an equity structure here, a debt equity structure here where we say the business should be 70% equity, 30% debt. So not a lot of debt. A lot of service businesses, you'll see only maybe 10% of their capital structure is in debt. The rest is in equity. Whether if you move on to a manufacturing company, heavy manufacturing, where they're borrowing money to invest in heavy equipment, that might be closer to 50-50. So for this example, we have 70% weighted to equity. When you weight 70% to the bigger number, of course, you're going to get a higher cost of your capital. So at the end of the day, when you add that up prior to the TCJA, we have a weighted average cost of capital of 13.1. Post TCJA, using a capital structure of 70-30, it's 13.3. Not a big change, but anytime you move that weighted average cost of capital up, thereby increasing the risk, it has an inverse relationship on value, so you're decreasing value. So if a company is not heavily debt laden in their capital structure, they're not going to see too much of a change in value in the, with respect to the denominator of the equation. We see more of the magic happening up in the cash flow in the numerator. So with respect to growth expectations, real quick, lower tax rates may not be a dollar for dollar trade-off, as I said from the beginning. Why? Because there are a number of things that are happening. You're going to be looking at the effective tax rate, obviously, for one. We're going to be looking at the timing of those tax shields, so that may have an impact on the value. But outside of that, we have a ton of clients whose customers are coming back and saying, hey, you guys are paying less tax now. Can you give me some breaks on pricing? Things are going to get more competitive. So that's going to affect the numerator, which is kind of a tangent or an offset, I guess, of the TCJA, but not truly reflective in the pronouncement of the TCJA. But as we said, much of the intent of the TCJA was to spur economic growth. And what we're seeing for a lot of our clients is, what are you going to do with that additional cash flow? Are you going to pay it out in bonuses? Or are you going to have more falling to the equity holders? Or are you going to invest more in your business and grow your business? So in summary, how do we believe that the TCJA will affect specifically the income approach evaluation? We think it will affect a lot of things. It will impact the models that we select. I think we're going to be moving to use more discounted cash flow models rather than that single year model that Brad spoke about. Cash flow calculations, the numerator will be tremendously affected by the enactment of the TCJA. Discount rates, I believe just slightly, so that risk rate probably not having a too tremendous of an impact, but as you move more to debt and you're restricted in deductibility of the interest, that will have some more of an impact. But we feel that at the end of the day, the most impactful element of the tax change is going to be in the federal income tax rates.
All right, now we're all experts in the income approach to valuation. We're going to move on to the market approach. When we talk about the market approach, I always relate it to a house appraisal because it's something that people are very familiar with. So my wife and I live in a community where all the houses are cookie cutter, they're about the same. We saw one house sell across the street for a certain price. We know that we put new floors in, we put new granite down in the kitchen. We can basically determine what our house is probably worth based on the fact that another similar house across the street sold. The same can be applied to business valuation. So if I have a pizza shop and I have a competitor right across the street, I have about the same number of pies that we produce every year, about the same profitability. He sells it for $1 million. I can pretty reasonably estimate what mine should be worth if I go to sell it as well. This approach itself has gained some popularity in the court system The reason, my thought on the reason being is, no offense to a jury of our peers, but it is very easy to understand from a simplistic method, right? So the income approach explaining benefit streams and cost of capital, a little bit more difficult to understand. The market approach, a lot more simpler to understand. Devil's always going to be in the details. The two different approaches that we're going to talk about today are the two primary methods. We're going to look at the guideline transaction method and the guideline public company method. Both of them basically have the same theory, being we're going to look at some type of transaction of a company, whether it be a private company or a public company. We're going to break that transaction down into some type of multiple of earnings. We're going to apply that multiple to our subject company. Again, the primary issue in this approach is finding enough either guideline transactions, companies that have sold, or guideline public companies that are sufficiently similar to our subject company. Now, in terms of the impact to the guideline transaction method, the guideline transaction method, as the name implies, means that we're going to be looking at transactions of privately held businesses that are reported to transaction databases, valuation databases, and determine if there's a sufficient number of those to which we can glean some data and apply those multiples to our subject company. What is going to happen after the Tax Cut and Jobs Act? We said in the income approach, it's highly likely that for the same businesses, after the Tax Cut and Jobs Act, the business value is going to rise by virtue of the expectation of paying less taxes, primarily. What is that going to do in terms of the impact on the transaction multiples that we're going to see in the databases? Well, the after-tax multiples, we don't think are going to change very much. So a discount rate, the WACC that Melissa came up with earlier, is really just a multiple in a different form. Whether you divide by 20% or multiply by 5 times, it's the same thing, right? So if we don't expect there to be a significant change in the discount rate of the numerator, it makes sense that we shouldn't expect to see a significant change in an after-tax multiple in the market approach. Pre-tax multiples, however, will see a change. Obviously, any change in tax code is going to impact what those pre-tax multiples look like. So what that means is we're not going to be changing any theory in the market approach. We're going to be changing how we have to apply that theory to the data that we can find. Here, we're going to look at what is the impact on one company. This is the same company under the old tax law and the new tax law. All other things consistent but for the expected taxes, income taxes that business is going to pay. So we have cash flow of $3.3 million. Our capitalization rate under the old law, or $3.3 million under the old law, our capitalization rate being 14%. The implied business value, or the purchase price in the transaction method, $23.8 million. Under the new law, again, all things being equal in the business, but for now we expect to pay less taxes on a go-forward basis. It's going to increase our cash flow from that $3.3 million to $3.8 million. What does that do to our value? It bumps it up to $27.5 million. In terms of our multiples, how does that affect them? You see the very bottom multiple, the cash flow multiple, and after-tax multiple. We don't expect to see much change there, little if any. However, all the pre-tax measures, revenue, EBITDA, EBIT, we're going to see increases in every single one of those multiples. So what does that mean in terms of being able to apply this approach now in a post-TCJA world? It means that any transaction that has occurred prior to the enactment of the Tax Cut and Jobs Act will need to be adjusted so that we can look at what that purchase price would have been had they expected to pay the level of taxes that we're now expecting under the Tax Cut and Jobs Act. So this is an example of the adjustment that would need to be made. So the left column being the hypothetical actual transaction that we pull out of a database. So database says that the cash flow of the business was $1.6 million. It says the purchase price was $10 million, implied multiple of 6 times. Happened in 2015, prior to any of these tax adjustments. Now, if we are going to be able to apply this transaction and the multiples from this transaction to a business after the Tax Cut and Jobs Act, we're going to have to adjust that tax rate. So the adjusted cash flow after changing that tax rate from 41 to 28.9 is $1.9 million. Again, we're going to use that same multiple because we don't think that the after-tax multiple or the discount rate is going to change very much, would give us an adjusted purchase price of $11.5 million. What it means is, had that investor in 2015 been looking at the business now in 2018, assuming or realizing that the business will be paying less taxes, it's more valuable. He's willing to pay more for that business. Now, in terms of what does that mean on the left side, these are the actual multiples that would have come out of the database. Can't apply those directly to our company because we know they're in a completely different tax regime. We're able to take that, I'm backing up one, we're able to take that 11.5 million and divide it over those same metrics to see what the increase in the multiples would be. An issue is going to be under this approach. Even if we have a sufficient number of companies that are exactly the same as our subject company, if we don't have all of this information to be able to adjust what the purchase price would be under the Tax Cut and Jobs Act, if we're only given these multiples, we're still not going to be able to use it, even if it's an exactly identical company to our own. Alternatively, on the guideline public company method, I'm going to back up to my days in finance, intro to finance. The efficient market hypothesis says that the trading price of a stock at any point in time takes into consideration all of the available information about that company. So where did we see that in practice? Think of the stock market in 2017. We saw this huge run-up in the prices of publicly traded stocks throughout the year in 2017. Obviously, there's a number of factors, so in fear of oversimplifying, I'm still going to say that a lot of that's going to have to do with the fact that investors became more and more comfortable with the fact that these tax cuts were imminent. So what they began to do is build that into the trading price of those public stocks. Now, in terms of what is this going to mean for the application of the guideline public company method, really it's making sure that the information used in those trading prices is the same information that is applied to your subject company. So making sure that the data valuation understand what information was known and what benefit stream is used to calculate that price to earnings multiple, and applying that consistently with our subject company. The third and final approach to valuation is the cost asset approach. So we looked at the income approach predicated on the ongoing earnings of the business, looked at the market approach, looking at other businesses that have been sold or that are currently trading. Cost asset approach is a balance sheet driven approach. So under the cost asset approach, you're really going to be looking at both sides of the balance sheet. You're going to try and determine what's the fair market value of all the assets on the left side of the balance sheet. And then you're going to determine what is the fair market value of all the liabilities on the right side of the balance sheet. The net assets, after you liquidate your assets and pay off your liabilities, that net asset value is your implied equity value. This method obviously is a liquidation premise of value. The only way we realize this is if we cease operations and liquidate the different pieces of the business. Now, in terms of how this is going to be impacted by the Tax Cuts Act, when we're looking at the left side of the balance sheet, when we're looking at the assets on the balance sheet and we're bringing them up to fair market value, again, the assumption is we would be hypothetically liquidating those assets. If the fair market value of those assets is over the tax value of those assets, it's going to trigger a built-in gains. So that built-in gains tax is then going to be needed to be recorded on the right side of the balance sheet. So we're going to be looking at every asset, determine fair market value, do we have a built-in gain that would be triggered upon the liquidation of that asset, and making sure that we calculate the tax and put that on the liabilities. Now, the impact of the Tax Cut and Jobs Act, we're going to be paying less tax on that built-in gain. What is that going to do to our net asset value, our implied equity value under the cost asset approach? It's going to decrease the amount of built-in gains tax. It's going to decrease that liability. It's going to increase our net asset value. It's going to increase our equity value.
My turn. I'm going to just take a few minutes, close this down. One of the things in the valuation community that we're faced with when we're valuing pass-through entities is the value of an S corporation worth more, is the value more than an otherwise identical C corporation? And we've wrestled with that in the past. One of the most outspoken voices in the community would be the IRS, saying that, hey, if you have an S corporation and they're not paying entity level tax, why aren't they worth more than a C corporation? And there were a couple of big tax court cases that actually did not tax effect in S corporation, therefore, in our opinion, overvaluing the entity because why somebody's paying the tax at the end of the day. So just to go through this real quickly, the issues that we tackle and why this is going to look a little bit differently post TCJA is for a number of reasons. Some of the things that we would look at is when we start out with that cash flow calculation, we started after tax cash flow, and we use corporate tax rates for S corps, for LLCs, for partnerships. And I won't get into the details, but there's a reason why we do use the C corporation rates. So, we have this as if it were taxed as a C corp. But what if we have this S corp that may have some other benefits? So after the IRS came out with these decisions, we started to look at, okay, what are the aspects of an S corp versus a C corp, and how can you calculate if there's a premium, and what is that premium amount? So the things that we were looking at is after we've applied that corporate tax rate, we have in the past we didn't have too much of a rate differential because why? The individual and the C corp rates, especially if you're in Pennsylvania, were almost right on. They were 41.5%. So at that point, not very much of a difference in taxation if you're taxed at the corporate level or if it's distributed out to you and you're taxed at the individual level. But now, post TCJA, we have a 21% federal tax rate and we have a 37% individual tax rate. So you can see that rate situation is something that's real and we need to look at. Then it gets muddied with the things that Bob and Dawn talked about this morning, dealing with the pass-through deduction that you can take. If you're a service business, you're SOL and you're going to be paying a higher tax rate on that pass-through income. So we'll take a look at that post TCJA. Another thing is we look at the benefit of avoiding that dividends tax. C corporation, we know that there's 2 levels of tax. That's why everybody migrated over to the S corp, because of that benefit in and of itself is huge. Well, now, since the rates are different, for C corporations, even if you are distributing and paying that double layer, that second layer of tax, that penalty is no longer as steep as it was before. But we're going to try to tackle some calculations to see how that impacts the value of an S corp versus C corp. And then lastly, another thing that we're looking at is when you invest in a C corporation, when I purchase my PPG stock and I pay $1,000 for it, that is my basis in the stock. So when I sell it, 20 years from now, I calculate my gain based on that $1,000 basis. Well, if you're a flow-through entity, if you're an S corporation, what happens? Your basis fluctuates. Your basis increases when you pass through income. It will decrease as you make a dividend distribution, but that basis fluctuates. It changes. So if you're a pass-through entity, you have the ability to increase that basis. So at the time that you sell your investment, maybe the capital gain isn't going to be as great as if you were a C corporation. So that's really the last aspect that we're going to look at when we're looking at the value difference between an S and a C corp. Don't have too much time to dive into that today, but there are a couple of examples in your book that are just going to lay out for you how difficult it's going to be on our parts in trying to quantify, if at all, if there's a premium ascribed to a pass-through entity over an otherwise identical C corporation. I have some closing slides. 1 second. So some concluding thoughts. Obviously, when you lower the tax rate, we're going to have a little bit more cash flow available in the business. We're going to see a short-term increase in the value of our businesses. And, we do a lot of ESOPs, employee stock ownership plans, annually. If the business didn't change at all, the dynamics of the business, risks didn't change at all from 17 to 18, the value is actually going to bump up merely because of the tax rates that we're applying. So what's that doing? That's building that future repurchase obligation out off in the horizon. So an issue that we're dealing with going from 1 year to another based on the changes in the tax rates. Long-term effects, some of the things that Bob and I and Brad have been kicking around, what if the business reinvests? When are we going to start to see the returns on that? We're going to have to start moving those DCFs out a little bit further. So another issue that we're going to have to tackle. But we feel that the impact of the TCJA is going to really be seen, as I said, in ESOPs, transactions. We've been talking to people in the marketplace. They said we're going to see a little bit of a blip in in multiples, EBITDA multiples, but they actually don't see them increasing as much as we've been talking about on the slides. Marital dissolutions, very different. You go through a marital dissolution on a business in 17, the value of the business is going to go up in 18, so issues you're going to be dealing with there. Equity owner buyouts. It was better to buy out the partner you didn't like or the shareholder you didn't like last year as opposed to this year because you're going to pay a little bit more. Gift and estate tax planning, although we're not seeing a ton of that going on until at the end when we're looking at the basis step up. But in conjunction with that planning, the value has gone up from one year to the next. So we certainly appreciate your attention. I have 1 minute to spare, Bob, but thank you so much for paying attention to our presentation. If you have any questions, we'll be around afterwards, or feel free to send us an email. Thank you so much.